Hello and welcome to the RiskWire webcast. Join us today for a discussion on the Federal Reserve's interest rate policy. I'm Reena Agrawal, research economist at Veros.
And I'm Eric Fox, chief economist at Veros.
Inflation continues to be a central concern for policymakers. It increased to 3.7% in August 2023. And the question now that looms large in the minds of economists, investors, and policymakers alike is, what will the Federal Reserve do now with respect to interest rates? What do you think, Eric?
Well, I think this is a very interesting question with the current CPI numbers that just came out showing an increase. It's clear that the inflation has not yet been tamed. Unemployment definitely is starting to go up as well, so they're beginning to have an impact on that. But I think it's very realistic to assume there's going to be at least one more 25 basis points hike by the Fed between now and the end of the year, most likely at the November meeting.
What do you think the Fed is doing differently now compared to how it was treating interest rates and monetary policy, let's say in 2020?
Well, I think it's a very different Fed now. If you look back at where the federal funds rate has been for over the past decade, it's essentially been at zero, which means the Fed had no policy tools to implement because they were at the zero lower bound for interest rates. And so they had to start with the quantitative easing, which they started in March 2020. Today, the federal funds rate is essentially at 5.5%. And that allows them now to have policy tools that allow them to increase and decrease the federal funds rate to speed up or slow down the economy. And that's what we're seeing them start to do now. And I think they're going to be very reluctant to give that power away in the future.
Thank you, Eric, for your insights into the Federal Reserve's possible policy moves going into the future. Thank you for joining us for this edition of the webcast. I'm Reena Agrawal.
And I'm Eric Fox.
Thank you.